I'm here in Dallas for REITWorld 2011, NAREIT's annual convention for all things REIT. Joining me is Hans Nordby, Managing Director with PPR, a CoStar Group company. What REIT sectors do you see as having the most favorable market conditions?
Well, in terms of property market fundamentals, Matt, if we look across the four major food groups, apartments are really in the catbird seat. Apartments, they've already seen most of their benefit in terms of the decrease in vacancy rates. Vacancy rates in the apartment sector have gone from about 8.3% at the end of 2009 to about 6.5% today, and they're going to just below 6. So they've already seen the benefit of the decrease in vacancy rates. This is when you get the honest to goodness rent growth. And we would expect a lot of the benefit here, Matt, is going to continue to accrue to Class A apartments, which is really where REITs tend to play. And there are several reasons for this. The big increase in jobs that we've seen over the course of the last year and a half has been predominantly amongst better educated people. They tend to have higher incomes and a proclivity to rent Class A apartments. Also, there's less of an interest in buying that condo as a means for getting rich. A lot less this year than in the past. Over time, and we're starting to see the beginning of this already, you'll see more construction in the markets about 2 years out. And you'll also see some other changes. The B and C apartments will do better when housing growth comes back in about 2 years, because a lot of those folks tend to be construction workers and maybe people who don't make as much money. So we think apartments are really in good shape. Also, we like warehouse a lot. Warehouse is a straight bet on GDP growth. The correlation between occupied warehouse space and GDP growth is 0.9, and there is nothing underway. So that's a pretty good bet as well.
And on the flip side, what about a sector that maybe is facing the toughest headwinds?
If we're talking about which way the wind's blowing, Matt, we would say office has it tough, and really it boils down to one thing. Now, apartments that we just talked about, that's an average 1-year lease term. So that turns over pretty fast. Now, that hurts in 2009 when the market's going down. You're rolling those rents down. The office sector in 2009, the NOIs felt pretty good, right? So you're losing some occupancy, but overall, you have a 5-year average lease term, doesn't hit you right away. Well, the flip side is you don't get the benefit of recovery right away either. And that's what's happening over the course of the next couple of years. What we anticipate happening is that we will see pain in net operating incomes because of rollovers through 2013. It hurts to roll over a 2008 lease until 2013. Thereafter, it starts to feel a little bit better.
And what about the impact that some of these looming debt maturities across the commercial real estate space will have on the listed REIT market?
Today, REITs have rebalanced balance sheets. They bit the bullet early. They cleared out their debt situation, and they're ready to go. And so in terms of looming maturities, REITs are in a good position to take advantage of that. However, here's the bad part for REITs. So they can afford to take advantage of it, but the markets that increasingly REIT analysts want REITs to invest in are the sexy six markets, I like to call them. The coastal markets, so Boston, New York, San Francisco, et cetera. Those markets, well, every foreigner wants to come in and buy a building. All the REITs want to buy there, and the big institutional money has decided, I'm reallocating, I only want to be in markets that I think are safe. So as a result, everybody showed up at the same time. And we think in many situations, those prices have become overwrought. So to the extent that REITs are willing to go to markets that are underfinanced and underbacked in terms of equity, they'll get the benefit. But in order to do that, they need to explain to the analyst why it's a good idea to go to Portland and Minneapolis. And boy, is that a tough sell with most REIT analysts.
For more from REITWorld 2011, be sure to visit REIT.com.